collateral, okay? Now they are going to want to make sure that you have some means of paying this back. They want to know that you make income somehow, but they're not going to be as stringent of questioning as a regular bank would be, and in fact a regular bank just wouldn't even look at you. But with these lenders, this is all that they do. And they're a temporary solution, and they know that they're a temporary solution. So if you're going to use one of these lenders, you're not locking in for a 5-year fixed. What you're going to be getting is a 1-year fixed, or a 2-year fixed, or a 1-year open, okay? And it just depends on the type of lender that you go to get this. Now, what are some of the things that you're going to be charged? Well, obviously a higher interest rate, okay? That's just the cost of a higher risk portfolio. As well, depending on whether it's an opened or closed mortgage and which lender you go to, there might be an upfront fee, okay? And this could be anywhere from 1% to 5%, depending on the lender and, again, the risk of the file. The other thing is the amount of down payment that they're going to want to see in the game. Now, if you have below 600 but you make decent income and you can prove that, well, then you know what? You can probably get an okay rate, a really low fee or no fee, and you'll probably only have to put down anywhere from, I'd say safely 25%, okay, as a down payment. However, if you have below 500, well, if you have below 500, you better have a good story for why you're below 500, a legitimate reason for that. But if you have below 500 or even below 550, then you need a good story. You're probably going to have a higher rate. You're probably going to have a penalty, but not always, or not rather a penalty, but a fee, but not always. There's lenders that have no fees. And you're also going to need higher down payment. It could range anywhere from the 25% all the way up to 35%, okay? Typically, you don't need more than 35% for any deal, but if you have more, obviously that just makes it a safer deal for the lender, and you're probably going to get better rates and fees because of it. So if you have bad credit or even horrible credit, if you have legitimate reason for why, and legitimate reasons can range anything from I was laid off, I was in a car accident, I got cancer, or I got a divorce even, because that can always be hairy, I was in a legal battle, my company was in a legal battle, or something like that. Legitimate reasons, a reason other than I don't like to pay my bills, then you can get a mortgage. You just simply have to throw money at the problem in way of fees, interest rates, and down payment. Okay, so if you have any questions about this, give me a call via Cost with the Mortgage Center. Always happy to help.